My name is Kirk Reagan, and I'm from High Fly Financial. And today I'm going to be talking about the Thrift Savings Plan. So all military have it, all federal civilians have it, and it is a powerful retirement plan for all of us. The most common question that I get asked is, well, what funds should I invest in the Thrift Savings Plan? And this really is critical. I came across a story once where somebody had invested their entire career, 20 years, into the G fund because they thought G was government and they worked for the government, so they should be investing in the government fund. So please pay attention in this video. If you've got any questions, please throw them in the comments and I'd be happy to answer them. All right, so we'll begin a little bit by talking about each individual fund. So the first one I want to talk about, and again, it goes from kind of the most aggressive to the most conservative, although there is room for a conversation as to how aggressive some of these top three are compared to each other. But we'll just list them as I have them here. The I fund. So I stands for international. And this recently changed in 2024. And it went from being mostly just a developed nations fund into a total international fund, where now it's including those emerging markets. And it still excludes Hong Kong and it excludes China. Now, this is a total international fund now, including over 5,500 different companies in over 40 countries. The next fund is the S fund. It's a small cap fund. It's basically the completion of the S&P 500. So you have your biggest 500 companies in the S&P 500, and then you have all of those smaller and even mid-cap stocks that are the extended market. And that's what the S fund is. It's just the completion of that 500 index fund. C fund. This is your 500 index fund. It's clear, plain and simple. The F fund, it's a bond fund and it follows the performance of the Bloomberg US Aggregate Bond Index. It's basically a normal bond fund for all intents and purposes. The G fund. The G fund's a little bit unique. It's also more like a bond fund, but it's also acts a little bit like a money market fund in that you cannot lose any money in this. It is for capital preservation. The other unique aspect of it is they basically buy government bonds that are only sold to the Thrift Savings Plan. So it is a little bit unique and it does have some unique performance aspects. All right, so let's take a look at the performance over time. So if we look at kind of the 1 year, you've got the C fund over on the right. It's the highest performing. Generally in the last even 10 to 15 years, the US performance has outperformed the international performance quite considerably. And you can see that in that 10-year time span there. The I fund's down at 6.4%. The C fund is at 13.4%. The extended market, that S fund, is at 9.51%. So clearly the C fund has outperformed that international fund. But what you'll find is if you look at the historical basis of how international performs compared to the US, it is cyclical. And so it does go back and forth. So just because the I fund is not performing as well in the 10-year does not mean it won't outperform the C fund in the next 10 years. It is cyclical. And so sometimes they do swap back and forth. If you look at it over the lifetimes, and again, not all these funds started at the same time, but you can see some rough estimates there as to what you can expect over the long run in these funds. The C fund, it goes back down to that approximately 11%, which is the historical performance of the S&P 500. And then the I fund down there at 5.57, again, because it hasn't performed well in recent performance. Because I get the question, how does the Thrift Savings Plan performance compare to my outside investments? And so I wanted to take a look at this. If we look at that G fund, really there's no comparison to it. If we just look at the money market funds of these other three companies, the performance of the G fund is higher and the expense ratio is significantly lower. So if you have an expense that's coming up in the near future and you want to make sure that that capital is preserved, there really isn't a better option than the G fund out there. Now the I fund. So the I fund, we look at the 10-year performance there. The I fund is at 6.4. The others are about the same. The Vanguard product, the VEA, has performed slightly better. And if you look at the expense ratios, they're all roughly the same. It looks like Vanguard's and Schwab's are a little bit lower there at 0.03 compared to the Thrift Savings Plan at 0.038, but not really any significant major differences between. If we look at the F fund, again, the Charles Schwab there, it is in yellow because it hasn't had a 10-year performance. So it isn't quite an apples to apples comparison. But if we look at there, the F fund has outperformed like the normal bond fund of Vanguard, and the normal bond fund in Fidelity. If we look at the expense ratios, we can see that Fidelity has the lowest at 0.025, and the F fund has it at 0.037. So even with those higher expense ratios, the 10-year performance has outperformed. So again, a solid option there for the F fund. If we look at the C fund, that's where you're going to have the most similarities between all the companies because they're investing in the exact same thing. They're trying to mirror the exact same index. So when you see those differences, they are very minute. Although the Charles Schwab is quite lower, the others are all about that 13.64% that the F fund is at. If you look at the expense ratios, you can see that Fidelity has a much lower one there at 0.015. And if you're a Fidelity customer, there's even options to get all the way down to 0 in another fund. But even if you look at it all together, it's still going to perform about the same across the board. So no real advantages or disadvantages in the C fund. The S fund, if we look at the S fund, again, Charles Schwab is a little bit lower, but the other two are about the same there, just slightly lower performance than the S fund. If you look at the expense ratios, a little bit higher on the S fund, a little bit lower on the Fidelity. But again, the overall performance of the S fund is the highest in the Thrift Savings Plan. So you can really debunk the rumor that the Thrift Savings Plan isn't a good plan. It's a solid plan with low expense ratios and high performing fund. The performance data in these charts is as of July 31st of 2025. This data was retrieved from Vanguard, Fidelity, and Schwab's website, as well as the Thrift Savings Plan website. All right, Lifecycle Funds. Lifecycle funds are a little bit different. What they're going to do is they're going to take your investment strategy, they're going to make it diversified from the very beginning. They're going to be using the I fund, the S fund, and the C fund in a diversified portfolio. And then over time, as you get closer and closer to the target date. Now, it doesn't necessarily need to be your retirement date. It could very well be the time that you expect to use the funds. And that may be a very different date than you plan to retire. So keep that in mind. It's not a retirement date, it's a target date. And so as you get closer to that target date, your overall portfolio is going to get more and more bond heavy. So you're going to see more and more of the F fund and the G fund. Now, the life cycle funds don't use a lot of the F fund, but they do use a lot of that G fund. So you'll see heavy percentages there all the way to the left. And once you get to your actual target date, you're going to see roughly 67% in that G fund. If you look down in your equity funds, well, now you're only going to see about 27% in equities. Let's take a look at how this changes over time. If we look at the life cycle funds, you can see the different colors here. And at the beginning, that light blue, that's your I fund. In the middle is your S fund. And in the bottom is your C fund. So C fund obviously taking up the most amount. If we add on the S fund, that's going to be your total US equity. So if we look at there at the very beginning, that's roughly a 65-35 split between US and international. And if you look at outside agencies like Vanguard, Fidelity, and Schwab, they're all roughly the same there at about a 60-40, 65-35, those type of ratios. So it's very similar to other outside products. And now as we hit that 30 years from the target date, that's when we're going to start to introduce those more conservative G and F funds. And eventually, by the time you get to the target date, now you're going to see, again, that much higher percentage, over 70% in the G and F funds. So again, some key takeaways from the life cycles: 99% stocks all the way up until 30 years prior to your target fund. So you're going to be heavily in equities all the way until the 30-year prior to your target date. Around 20 years, that's where you're going to get to 77% stocks and 23% bonds. And then that 5 years prior to retirement, that's where you're going to hit that 60-40. So if you look at a lot of outside companies, a lot of times they're wrestling in around 60-40 to 40-60 in retirement. So anywhere in that range based on personal risk tolerance. Now, at that target year and beyond, now you're going to see a much bigger swing. You're going to see only 27% stocks and 73% bonds. So that is quite a conservative approach compared to some of the other outside organizations. The other thing that's nice is those expense ratios are very low. In their target date funds, they're only 0.039, and even all the way down to 0.037 in your lifetime funds. generally, you're not going to see those low expense ratios in outside companies because of the manual adjustments that they're making to those different percentages, and they're doing it at a regular basis. So a great job by the Thrift Savings Plan in keeping those life cycle expense ratios extremely low. All right, so we get down to the age-old question of which fund is best for you. So if you want that easy button, maybe the target date retirement funds are right for you, those life cycle funds. And you pick a date, but try to pick the date of when you're going to plan to use the fund. Don't pick necessarily the date that you're going to retire from the military, because those funds may still grow for another 20 years, and you could have them in much more conservative investments if you choose your military retirement date. So think again, not necessarily on your retirement date, but the date that you actually want to access the funds, and pick that date if you're going to go that way. The life cycle funds are a one-size-fits-all solution though, and it may not be appropriate in your situation. Maybe you don't want to get that conservative when you get all the way down into the lifetime income funds. Maybe you want to keep it more at 60-40 or 40-60. So that's something that you'll need to look at in those last 5 years if you choose that option. Maybe you do a rollover, or maybe you switch things up when you get within those last 5 years if you don't want to get that conservative. Other factors, your own personal risk tolerance. How accepting of risk are you? Is this going to be used to spend on vacations, on going out to eat, or is this going to be spent on rent and grocery bills? That makes a big difference on how aggressive or conservative you want to be. The other thing is your sources of retirement income and spending. Are you generally paying the majority of your bills through pensions and Social Security, or are you relying on these accounts again to buy groceries and to pay for rent? The other thing is your health. How good is your health, and how long do you expect to live? Other thing is your outside investments. Maybe your outside investments are much more aggressive and you want to leave these as slightly more conservative. So again, those outside investments and the character of those outside investments, meaning are they Roth, are they traditional, or are they in a taxable account? So all of those factors play into your unique situation. So here are some options that you can think about. You can pick that farthest year out, and it will maintain 99% equity. So you say, hey, I don't want to invest in the bond funds right now. I want to stay all in equity. Well, then go ahead and pick the farthest date out you have, and just make sure that you make a change before you get to that 30-year mark, 30 years before that date, because then it'll start to introduce those things. So if you just want to leave it as that diversified C fund, S fund, I fund, then go ahead and choose that furthest date out, and that'll provide that 65 US, 35 international mix that you're probably looking for. If you want, the life cycle funds are a little bit conservative. You can always pick a date that's a little bit further out than your actual date that you plan to use the funds. That way, it'll tend to be a little bit more aggressive in its stance towards how it's investing in asset classes. The other thing to consider is what we call the shelves. So your tax deferred, your tax free, which is your Roth, and your taxable accounts. They're very different types of accounts, and they need to be handled differently in your withdrawal plan. Generally, you're going to find that your bonds and your fixed income are going to do better in your tax deferred accounts. So if you have all tax deferred accounts in the Thrift Savings Plan and all your Roth accounts outside, that's something to consider. Well, maybe you want to be a little bit more bond heavy in your Thrift Savings Plan because that's where your tax deferred assets are. If you're looking to say, hey, I just want to invest in US companies, well, then you're going to be looking for about an 80-20 split. So 80% the C fund and 20% in the S fund. And that combination will roughly comprise the entire US stock market according to market capitalization. So more of your money will be invested in the most expensive companies, and less of your money will be invested in the penny stocks. And like I said previously, if you've got something that's coming up and you want to make sure that your capital is preserved, then that G fund may be your best option. Again, not everybody's situation is the same. So please consider all these different factors and all the different options. And if you still have any questions, please reach out. I'd be glad to go over your specific situation and make specific recommendations that would be appropriate to you. Well, I hope you like this video on the Thrift Savings Plan, and I look forward to bringing more like this to you in the future. If you would like to see those videos, please subscribe and go ahead and like this video. If you've got a question about what I presented today, or if you would like to see a video done on a different topic, Go ahead and throw it in the comments. I'd love to hear from you.
Information provided in this video is for educational and informational purposes only and does not constitute financial, investment, tax, or legal advice. I am not your financial advisor, and you should consult with a qualified professional before making any financial decisions. All investments involve risks, including the potential loss of principal. Past performance is not indicative of future results. This video does not endorse any specific investment or strategy. By watching this video, you agree that I am not responsible for any financial outcomes based on the information provided.